Hi, my name is Adam Creed. I'm a sales director here at Canada Life Asset Management. I'm here today with Mike Willens and Bimal Patel, who co-manage Canada Life's global equity strategy. Mike, Bimal, could you explain how you put together a core global equity portfolio?
It's all about getting exposures to a wide variety of factors and styles. So we want to construct a portfolio that doesn't have overt stylistic bias. And this is particularly important over the last few years, where we've had a macroeconomic environment that has ebbed and flowed from low interest rates and low inflation to very high interest rates and very high inflation. So we think that a core approach provides a diversified and stable source of returns in a fairly volatile economic environment.
And what that's led to, interestingly, is some very different years. So 2020 was very different to 21 and 22. So 2021 was very much a growth year, and 2022 was very much a value year. And our approach has led to outperformance in both of those phases. So in terms of the valuation opportunities that present, it's particularly important to be pragmatic with a core approach, and we think that gives better returns over time.
Could you give an example of how that pragmatic approach works in the portfolio, perhaps with a stock example or something like that?
Yeah, sure. So Netflix is probably a good example. We had this period before COVID hit where Netflix was seen as a structural share gainer. It was on a premium valuation. The subscriber numbers were constantly rising and beating expectations. Then COVID hit, and everyone was locked down, and that was really the perfect quarter for Netflix, and you saw that in the subscriber numbers. And back then, actually, there was this narrative about growth is going to be structurally higher for software companies because of COVID. That was a narrative that was wrong. In reality, it was just pull forward of demand. And then clearly governments reopened economies, and everybody went out and went to restaurants and to do other things that were more interesting than watching Netflix. And so we saw a valuation compression. We saw concerns about content spend, particularly from companies like Disney that were devoting huge amounts of capital, as well as large companies like Apple, for example, that were entering the space. And then obviously in 2022, the Fed became very hawkish and increased interest rates significantly. That pushed down the valuations for a variety of growth stocks, and Netflix valuation declined as well. There was a point in 2022 when Netflix was trading at a discount to the broad market. That was a valuation dislocation in our view, and we entered a position in Netflix at that time because we continued to think, and we thought at that time that Netflix deserves to trade at a premium to the market because it's a company with great content, a great moat, and so we have a positive view on subscribers.
It's important to say there's always a macro component to this too. So it's the macro component that gives the valuation discrepancies that we then take advantage of. So COVID in that respect is such a good example because it allowed entrenched beliefs to take place that COVID would be with us forever, that we would be working at home forever. And in turn, that leads to assumptions which you can challenge. So Netflix is such a good example of that in the sense that as the story changes, so the valuation changes. And that gives us the opportunities in terms of entry and exit points on a stock like Netflix.
So it's that relationship between how you're able to challenge the existing macro narratives with valuation opportunities presenting themselves in stocks almost regardless of sector or style, and that allows you to build that core portfolio that is aiming to deliver across all parts of the cycle, not just being reliant on one particular driver of return.
Yeah, that's exactly correct. And there have been loads of situations and narratives that have just been proven to be wrong, like the whole transitory versus persistent inflation. That was that feels like a long time ago, but there were a lot of people that were calling for transitory inflation, and we have had very, very high inflation for a number of years now. So clearly this is something to be considered in the investment decision making process.
So 2022 was such a good example of this. So inflation was high in 2022, but we very much felt it was about to peak. And in turn, it's so obvious the valuation discrepancies that are generated. So many growth stocks underperformed in 2022. It was not a bottom-up construct. For us, it's very much about interest rates and the impact upon individual stocks and sectors. So in middle 22, we were really able to take advantage of that and buy a whole range of growth stocks with strong moats at valuations that had not been seen for a long time.
I think many people are surprised actually that many of these companies are great companies, but they still really struggled. And it's a misunderstanding of the importance of interest rates and discount rates. And that's something that we do spend a lot of time on.
Mike, Bimal, thank you very much for your time.